Welcome to Real Estate Accredited Multifamily Real Estate Virtual Meetup. Thursdays at 7 p.m. every Thursday. Presentations are recorded for future use and distribution. Our purpose here is to educate with real estate topics and related type of educational material and with some networking. So we are here every Thursday evening at 7 p.m. And if you have any questions or want to cover a specific topic, always feel free to email us for some ideas. So without further ado, Philip Schuligan, he's going to present the topic of the week and take it away.
All right. Thank you, Jeff. Welcome to Real Estate Accredited, our Thursday, 7 p.m. Eastern, every Thursday, as Jeff mentioned. We focus on in-place commercial multifamily value add. And the topic of the week is tailwinds that may increase profits in a real estate investment. In the first 4 slides, wanted to take the opportunity to go over a few of the basics. Actually, I realize sometimes when I speak to some students, surprisingly, they don't understand necessarily when the basics. Today, I just wanted to go over some of those. How do we make money in in-place commercial multifamily value-add investment? And you may argue, like, why choosing an in-place, meaning that it's already built, investment, and why does it have to be value add? So the in-place part is to obtain cash flow day one, right? And you're going to look for deals that will allow you day one to generate some money, and you don't have to wait, for instance, for a property to be built for 6 months or a year if it's a larger project, for instance. So you're going to look for a deal that is going to cash flow day one, that is going to generate typically between 5 and 10% per year of return on investment. All right, that's also called the cash on cash. The value add portion is you're going to increase the value by forcing appreciation, right? And that will generate a return on investment of 50 to 70% over the hold period of the particular property. So you're going to execute a value add business plan to increase the net operating income. And in turn, that will increase the value that you can collect at the capital event, either disposition or refinance. So the sum of the forced appreciation, the 50 to 70%, plus the yearly cash on cash, that's going to be all the returns that you're going to get on a in-place commercial multifamily value add investment. Okay, so I started to use some colors: blue for cash flow, yellow for value, and this orange, I guess, for NOI, net operating income. That's something I'm going to use over the next slides. Again, as mentioned, we'll go about some definitions. What's the link between what is net operating income and what is the cash flow? Cash flow, also called net income, is the difference between the net operating income and debt servicing, so paying the mortgage on the property, and also any partnership costs and fees. Now, the NOI is a very important number that we're going to use in the coming slides. That's why it's highlighted. So what is the NOI? What's the definition? It's going to be the rental income plus any other income that could come from fees, application fees, late fees. They could be the RUBs, meaning like when people paid the utilities to the owner, and things of that nature. That's going to be other income. And so rental income plus other income minus operations expenses. So the costs to operate the property. Now, just for some rules of thumb, usually like a good guideline, it's not true for every deal in every market, but a good guideline is you can use 50% in the operating expenses, 50% of the rental income plus other income. So 50% of the sum of those would be on expenses. So from that standpoint, if you increase the NOI, you will increase the cash flow, you will increase the returns on the property. Okay, and we'll come back to that when we'll review the different tailwinds. Increase NOI, increase cash flow. Next, again, some definitions. What's the relationship between the NOI, the net operating income, the value of a property, and the capitalization rate or cap rate? The formula is cap rate equals NOI, net operating income, divided by value. And in order to establish the NOI, you're going to look at comparable sales to the subject property and just extract the data, extract the net operating income for all of them, as well as the value, and that will give you the cap rate for that particular market. If we continue with this cap rate formula.
A wild day.
Hello, Paula. Welcome. So cap rate, NOI divided by value, I just mentioned, if you swap these two terms, means that value equals NOI divided by cap rate. So again, if we increase the NOI, we're also going to increase the value. We increase the NOI, we're going to increase the value. So far, so good. I'm sorry, I just muted you, Paula. If you want to talk, you'll have to unmute or type a comment. All right, if we're good, so far, so good, we'll carry on. Tailwind number one, and it might be counter-intuitive, but higher inflation will boost the NOI. And I used a very simple baseline of 100,000 of income. I applied the 50% for expenses and applied a 3% inflation rate to both on the left side. And then I applied a 10% inflation rate on a yearly basis on the right side. So you end up year 5, you started with a $50,000 NOI, and you end up with $56,000 NOI with a 3% inflation. In the chart on the right with 10% inflation, you start 50,000, you end up at $73,000 NOI. Okay, so income minus expenses equals NOI. So in that case, what we discussed over the past several slides, we increase the NOI. That's going to have an effect on cash flow, and that's going to have an effect on value. Increase NOI, increase cash flow, increase NOI, increase value. That's tailwind number one. Along the same lines, reusing that formula, relationship between NOI, net operating income, cap rate, and value. If the cap rate is going to get lower because it's at the denominator, it's going to, a lower cap rate will increase the value of the property. Right? So what we experienced until recently, it was generally lower cap rates. And we spoke in prior calls about the relationship between cap rates and interest rates, which explain the higher cap rates currently. But if you are in an environment where cap rates are compressing, that will increase the value of the property and you will make more profits. Okay. And that should say number 3. Housing demand, right? So we spoke about NOI previously, rental income plus other income minus operations expenses. But in turn, the rental income is going to be the gross rental income, which is really like the average rent that, or let's say the market rent that you're going to be able to collect on all the units, minus vacancy, minus concessions, loss to lease, and bad debt. So because it's negative, if you lower the vacancy, it's going to increase rental income. Increase of rental income, you will increase the NOI. Okay? That's the relationship. Lower vacancy, you increase the NOI. What has happened and over the past few years, and that's something I know we spoke several times about this, there's been, in general, a lower vacancy rate overall nationwide on all rental units because there's there's a very strong housing demand on the market right now, where there's a short supply of rental units available. So historically, since 2008, we've witnessed lower vacancy rates. And these days it turned a little bit around. Like the trend has been pretty consistent. And when I remember several years ago, we used to use maybe 10% as a baseline for vacancy. Now we could really use 7, maybe. But again, that's nationwide. You have to look market by market. But again, lower vacancy.
So Philip,
anyway, go ahead, Rajiv.
I was wondering if this year the housing market is crashing, right? Because of the higher rates. So does that increase the rental demand, housing demand? Because people who are supposed to buy houses are not buying the houses.
Whomever was planning to buy a house, or they may delay. Actually, I was just talking a couple of days ago to someone who was in that situation, and he's running a business in Atlanta, but when he was looking for a house at some point, he was like, yeah, I own my house. I have 2.5% interest rate. Plus his daughters, they're still in school, and I think they are in Denver. So he's commuting for now, that's tough. But so he's renting during the week. He has to rent. People are more hesitant to acquire real estate, and I think if I remember when we studied the housing demand and what does that mean? Where is it coming from? And actually, I know we have a chart we found. Historically, if you're looking at the number of new families who traditionally would buy houses, that got lower for number of reasons. And at the same time, so instead of buying houses, they end up renting. And that's where there's a pressure on rental units. It's just because they're buying less for various reasons. And obviously now, with the interest rates being higher, it's even harder to buy a house. So you have like more young families, or like young professionals and so on. They're like, oh man, I'm going to rent. And at the same time, there was, I think there's a what is it, Generation Z or whatever, that some habits changed for some of these younger people, and they prefer to rent. It's more part
Yeah,
of
it
the
became
lifestyle and so on.
yeah, it became a renter generation because of the, and you probably seen it, Rajiv, like younger folks, they'll stay at jobs 3 to 5 years and want to move on and find a different job. So if obviously they buy something, they're invested into that area. So in order to be able to have that flexibility, and I see it also, some folks around here, they want to be able to
Yeah.
move, especially like in DC, the DC area. People don't, one, they can't afford it, but two, they like to be able to be more of a, I don't know, just move on a whim. If they find something better, just leave. So if they're tied to a property they own, they don't want to be
Yeah.
landlords. They just want to rent on to the next place and move on and
Yeah.
experience life. And they find a job in Denver. Okay, I'm moving from DC to Denver and not really put. And then in addition, people are having kids later and later. So there's no rush to buy houses because the rentals are.
Yeah. Actually, so these aspects, like these longer term trends, those aspects are probably not captured in these statistics. So if you see the rate at which people are having kids going slower, marriage rates are going lower. So if there are more single people, they will tend to rent more long term.
Mm-hmm. Yeah.
Yep. Next slide. I just added like a tailwind number 5, and that's more. Everything else was, let's say, more like the economy in general. So we had the inflation. Then we spoke about cap compression and vacancy. So it's all factors that you cannot control. But I just wanted to add something about things that you may be able to control. And from that standpoint, I think when you're going to go in with a particular business plan, you're going to make a set of assumptions based on the research and due diligence that you're going to run up to that point. And I think what usually, or sometimes, let's say, what may happen is you identify new opportunities during the life or the ownership of that particular property. And I know, for instance, that's something that we did, like bulk internet cable contracts. Maybe initially the property was not necessarily the right size, but then something changed on the cable provider side, or there's a new player in town and wants to get business, and then there's a new opportunity. Another thing is the valet trash and preferred parking. I think similarly, some of the newer services, that some of these services may work in some markets, they may not in other markets. The odds that these services will work better if other properties are doing it, those are things that you may want to try once you own the particular property, but not necessarily count into your business plan. And I just put some examples. Obviously, there are a number of other examples that you can apply as a source of additional income. Similarly, on the expenses.
So Philip,
yeah, go ahead.
So Philip, do you see scenarios or cases where you buy a property and then you completely pivot and use it for a different demographic? Like you buy a property and then make it 55 plus senior living and add other kinds of services that may add additional income to that. Do you ever see that, or
No, I've never heard
is
of
it too
that.
much to?
Yeah, because so, and anything with a particular demographic, that includes students, like, yeah, if it's senior, or let's say living not necessarily assisted but more senior, it could imply pretty significant changes in what. Oh, sushi is joining, and that's something you really should take into account in your business plan up front, because it could be very,
it's
very
a significant
dimensioning.
risk, right?
Yeah, it's very dimensioning. And I would say, moreover, the risk with that, it's, for instance, I know particularly small balance loan from Freddie, they have limitations on some populations. And I know they don't lend on student housing.
Okay.
I'm not sure why, but they have maybe they have the dedicated product in that applies. And for some reason, there are some limitations of that nature. And if you start pivoting like that, you have to work with your lender. And and the answer could be no, that they just don't want to do that. And meanwhile, it could be also that the particular lender, they have maybe like a mission. And I know it's true for HUD, and which is the housing and industrial department or something like that. I don't know what it stands for, but they're doing some loans, and their mission is really to develop housing, improve our housing, and so on. Like, the asset needs to meet some criteria.
And also, what about you have to take into account the existing tenants too, right? If it's 60% vacancy rate, if you're just changing the demographic, then how do you handle the tenants already there? So
Absolutely. I think there's always, when you're going to make a change, there's a risk, because now, let's say you're turning, and either way, let's say you have mostly families, and then you say, now I want to do 55 and older. Like, maybe families are going to run away at some point because there are too many old elderly people. And same thing if it's students, they may not be happy of the environment, the way it is changing. It's like too noisy, or too this, too that. Or maybe like now the elderly people, they are complaining because you always say 55 plus, the reality is like 70 plus. And maybe these older tenants, they may not like to have young families around because they're noisy and etc. But yeah, I was here. Okay, yeah, that's all I have for tonight. Let's see if Paula can connect. Yeah, I think she's like half connected again.
All right, I hear somebody's TV in the background. Paula, are you there? Oh, okay. Well, all right. This includes a period of instructions from our Philip Schilligan. If Paula, if you have any questions, you can hear us, do let us know. Type in the chat, because we cannot hear you if you are saying anything. We never got your request of a specific topic. So if you do have a request, feel free to get it to Philippe or myself. You got the email addresses, the contact information, and we want to be able to taper it to people that want to learn about this stuff. If Philippe, you got anything else to go over?
No, I was just about to say, actually, we have a call scheduled with Paula tomorrow.